Hey guys, welcome back to another video. Happy Friday. Finally, it's Friday, and to top it off, it's a long weekend. So when booking loads, make sure to book loads that will cover Saturday, Sunday, and Monday. So since it's the end of the week, it's time to do another market update and forecast. Now, if you're new to this channel, welcome. I teach about the trucking industry with a heavy focus on the spot market as well as freight market analysis. So if this is a topic that interests you, feel free to subscribe down below. Anyway, let's jump right into it and take a look at what happened in the market last week and what we can expect for next week. Ready? Let's go. Okay, we always start with the outbound tender volumes versus tender rejections. Now, for new viewers or those that are not familiar with the terms, I will remind you. Outbound tender volumes, this blue line right here, tells us how much freight there is in the market. So it basically tells us the demand side of the industry. The more freight there is in the market, the more shippers need trucks to move that freight. Tender rejections, the white line right here, tells us how much of the contract freight is getting pushed into the spot market. Now, tender rejections give us an idea of what the capacity is like. When there is overcapacity, the tender rejection rate is usually low. When there is undercapacity, that means that the tender rejection is high. Now, another thing to note is that tender rejections and spot rates follow a similar pattern. The higher a tender rejection rate is, the higher the spot market rate is. So what we want to see, of course, is we want the volumes to be high. We want the tender rejections to be high. What can we see right now? So here we are right here. What we can see is that since around May 14th, if you can see it, here it is, since around May 14th, and I will attach these down below. Since May 14th, tender rejections started climbing, which is a good sign. To top it off, around May 15th or 16th, volumes also started climbing, which is also a good sign. Now, something to remember is, of course, the DOT inspection week, which could have affected the tender rejections. Many carriers choose to park their trucks during that week of inspections, and therefore capacity decreases. And any decrease in capacity could push up those tender rejections. But for now, tender rejections are at 3.23%, which means that 3.23% of contract freight is ending up on the spot market. Not a lot, but at least it's over 3%, which we have not seen in a while. Now let's take a look at how rejection rates changed for each equipment type: flatbed, dry van, and reefer. And this is a change over the past week. So for flatbed, the blue line right here, tender rejections actually dropped by 5.6%. So not the greatest news. If we look at dry vans, which is the green line right here, they increased by 18.4% since last week. For reefers right here, they increased by a whopping 31.5% since last week. So what does that mean? Well, it means that for dry vans and reefers, we can expect the spot rates to be a little bit higher next week than last week. For flatbeds, not so much. Now, the question is, why is it that we can expect the rates to be higher next week? Well, because tender rejections and spot rates follow a very similar pattern. But the thing is, spot rates lag behind tender rejections. First, tender rejections go up, then that load takes several days to actually hit the spot market, therefore increasing volumes, and then the rates start increasing. I hope that makes sense. Now, the National Truckload Index for line haul only, which is this chart right here. A reminder, this data is based on dry vans, not any other equipment. It's based on average dry van spot rates, excluding fuel surcharge. So currently, the spot rate for dry vans on average without fuel surcharge is $1.59 per mile, which is extremely low. But we can see that it has been climbing up since around the 14th, even a little bit before the 14th. This is partially because those tender rejections started climbing up, and the spot market does follow the tender rejections. Now, if we take a look at the spread between contract and spot rates, unfortunately, I don't have the best news here. We can see that the spread is 94 cents. That means that contract freight pays on average 94 cents more than the spot market per mile. So this spread, unfortunately, it continues increasing. As you can see, it continues increasing and increasing. And unfortunately, we're facing an issue where a ton of volume is getting awarded to the contract market. So the spot market is left with pretty much nothing and it's suffering. That's the thing about spot market. Spot market changes daily depending on what the environment or the economy or whatnot, what the situation is on a daily basis. Whereas the contract market, it's a little bit more stable. Now, I usually show this at the end of the video, but hey, let's change it up a bit. Now we're looking at diesel truck stop actual price per gallon, and we can see that diesel prices have continuously been going down, although from around the 22nd until now, they have plateaued a little bit. And currently we're at $4.04 per gallon, which is a decrease by 1 cent since the beginning of the week, I believe, something like that. Now, if we take a look at this chart, it shows us market areas and whether diesel prices increased or decreased in those market areas. If the square is red, that means there was a decrease, and then there is a percentage. I will attach this down below so you can see it closer. We can see there were some increases in some areas of Montana and in North Dakota. Everywhere else where it's red, there was a decrease or an insignificant change. So at least we have that going for us. Okay, now let's get into some specifics, starting with dry vans. And we're going to be looking at spot rates first. And this chart is provided by FTR Intel. Now, the blue bar is the current year, 2023, and you can see what the average weekly broker posted rate per mile is. This is by week. This dotted line is the 5-year average. The green line is 2021. The orange one is 2022. The first thing we can see is that the spot rates in general for dry vans are below the 5-year average, as well as 2021 and 2022. We can also see that there was a jump right here last week, and this is partially because tender rejections increased because a ton of trucks decided not to run and therefore capacity decreased. So you can see how sensitive the market is. Now, the thing I also wanted to show you is the pattern, the 5-year average pattern, which is this black dotted line. It seems like in general, even this year, even though it's below the 5-year average, it is following a similar pattern. So if it continues following the 5-year average pattern, we can assume that possibly dry van rates will increase a little bit and then stabilize and increase at the end of the year. Here is hoping. Then we have this map which shows us dry van volumes. These are not spot volumes, these are general volumes. The color of an area shows us whether volumes increased or decreased from last week. Red means a decrease, blue means an increase. The height of a market shows us general volume from that area. For example, from Atlanta, Georgia, you can see there's usually a ton of volume. But if we look at this map as a whole, we can see that for the most part, it is red, which means that volumes for dry vans have decreased across the board, except for certain market areas such as Colorado. We have Montana, North Dakota, South Dakota, Mississippi, part of Michigan, part of Minnesota, and part of Wisconsin. Now, the question is, what happened over the past week that made these volumes drop across the board? Honestly, I have no idea what happened, what could have caused such a drop in volume across the board. But if anyone knows, please comment down below. Here we have another map showing the rejection rates for dry vans. It works the same way as the volume map. Color shows us weekly changes. Height shows us how many total tender rejections are there. So I can confidently say that there is no real pattern here. It's kind of all over the place, right? There are some blue areas where rejections increased, some red. On the eastern part, it looks like there were a ton of markets that didn't experience change. Texas didn't experience change, and the West Coast. It looks like most of the action is happening here in terms of increases and decreases of tender rejections. So if we look at this map, this is the head haul index for dry van. If a market is red, that means there are more trucks delivering to that market than there are loads coming out. Overcapacity, no negotiating power for the carrier. If a market is blue, it's the opposite. There are more loads coming out than trucks delivering to that market area. Loose capacity, more negotiating power. So we can see for the most part, as it is every week, the map is red. However, we can see that Southern California doesn't have as much capacity compared to loads, right? There are more loads than there are trucks delivering there. And of course, the eastern portion of the US. Another market is the Fort Worth, Texas market. But something you have to remember about head haul, the way this data is collected is from tender rejections. So if you have a load that's, for example, going from Phoenix, Arizona and delivering to, I don't know, somewhere in Ohio right here, that doesn't mean that you're going to the greatest market, because what this data doesn't show is the people from here, from Pittsburgh, that are deadheading to Ohio to get their next load. So this overcapacity starts bleeding into the states where it looks like there is a lack of capacity. Does that make sense? Now, in terms of where to go if you have a dry van, or where would I go? What I am looking for, or what this map shows us, is tender rejections versus volumes. The bluer a market area, the higher the tender rejections, which is good. The height of a market area shows us volume. The higher it is, the more volume. What we want to see is a market where it's extremely blue, like this color, with high volume, because then there are a ton of loads there and a lot of them are getting pushed to the spot market, increasing that volume on the load board. So from here, I can see that it looks like Houston is still an interesting place to be, just because the volume is there. I realize that it is not as dark blue as Minnesota and Wisconsin and Louisville. But the thing is, in these places, the volume is smaller. Of course, these are interesting places to be, much better than Sioux Falls right here, because this one is completely flat. But still, in Houston, at least there is more volume. If I was running a dry van, I would go from Houston to Iowa, maybe hitting Wisconsin, Minneapolis, Minnesota, Louisville, Kentucky, maybe sometimes hitting Michigan. Those are the areas that seem relatively better to other areas. Again, relatively, it does not mean that you're going to be getting some insane rate per mile. It just means that you would be getting a better rate per mile than if you were grabbing a load from, I don't know, somewhere in Nevada, where it's flat and gray. Now for reefers, starting with the spot rates. Again, the blue line is the current year, the dotted is the 5-year average, green is 2021, and orange is 2022. We can see that reefer rates just hit the 5-year average approximately, but they're still below. They did increase over the last week, again, probably because those tender rejections increased, pushed more volume into the spot market, and with the decrease in capacity, rates started going up. Again, market is very sensitive. Now, just like with the dry van, we can see that the reefer spot rates are also following a similar pattern to the 5-year average. So we can expect, hopefully, that reefer rates might, they might go up a little bit and then go up at the end of the year. That I'm not worried about. But for me, the most important thing is that they start following this pattern right here and going up. Here's hoping again. So now we're looking at the map, which shows us reefer volumes. As a reminder, blue means an increase in volumes from last week. Red means a decrease. Gray is no significant change. And the height shows us the general volume in the area. What we can see is that it's a pretty boring map. It's pretty gray all around. But there were some volume increases in Idaho, in Nogales, Arizona, which is not surprising, produce. What did surprise me is the volume decrease in California. This is the time when produce should start happening. It's not happening yet. Then we see some increases in the Houston area, but it's a pretty flat area. Some places in the Midwest and in the Southeast. But in general, pretty map. Now, if we look at tender rejections, we can see that it's red and gray pretty much everywhere with some slivers of blue. There's a little bit of increase in rejections here, nothing crazy. What really surprised me is the increase in rejections in the Southeast, in North Carolina, South Carolina, Georgia, and northern Florida, the Jacksonville, Florida area. I don't know what happened in the Southeast that prompted such an increase in tender rejections in states that are so close together, right? I have no idea what happened, but there must be an explanation for this. So if you guys know, let me know. Now looking at the head haul index for reefers. The first thing we can see is that it's not as bad as for dry vans. There's not as much overcapacity, right? There's a little bit of red, a little bit of blue. It is a colorful map. Some things that we can notice is that Central California has more loads coming out than there are trucks delivering to that area. Same thing with Nogales, Arizona. Nogales is not a very popular market for reefers because the wait times are insane. Now, there are also states in the Midwest like Iowa, parts of South Dakota, Nebraska, Kansas, Indiana, some places in the East Coast, as well as in Central Florida and Texas, where there are more loads than there are trucks. And of course, Idaho. I nearly forgot Idaho and the Pendleton, Oregon market. So yeah, not as bad of a situation as with dry vans, but there's still overcapacity in certain markets. So where do you need to go if you have a reefer? Well, again, we're looking for a place that is tall, it has a ton of volume, and a place that is as dark blue as possible, preferably this color, because that means there are a ton of tender rejections. And as a reminder, that means that more volume is getting pushed to the spot market. Now, what I can see is I would probably, again, stay within the Pendleton, Oregon area, maybe Idaho, going to, well, Fort Worth there's volume there, but it looks like the tender rejections are fizzling out. We see that Iowa is interesting. An interesting market is also Southern California. Now, I know that the volumes decreased there, but if we look at the head haul index, which I just showed, we know that there are more loads than trucks in Central California. So you could just deadhead a little bit. Just keep in mind that California has some of the highest fuel prices, but this is a market I would probably explore. The reason I'm not saying much about the Southeast is because even though the tender rejections are high, as we can see by the color, look at how flat it all is. That means there is no volume, so there's not going to be much on the load board. Finally, we have flatbeds, starting with spot rates. Again, blue graph is the current year, orange is 2022, green is 2021, and the dotted line is the 5-year average. Now, we can see that we have been trending above the 5-year average in terms of spot rates for the flatbed. We can also see that there was not as much of an increase in spot rates during the DOT inspection week as there were with dry vans and reefers. And this is partially the reason why I didn't feel a difference. We operate only flatbeds at the moment. Maybe that's what it is. Now, of course, I want to look at the pattern, the 5-year pattern. It looks like we are following it more or less, maybe not as closely as reefers and dry vans are following the 5-year pattern. But something I want to show you is that according to the 5-year data, flatbed rates tend to peak somewhere in August and then they start going down. Again, flatbed is very seasonal, right? It's the most seasonal trailer. So unfortunately, this is what the pattern looks like, and I hope that we don't follow it this year because we operate only flatbeds at the moment, but we shall see. Now, in terms of best places to go, again, this is data from TruckStop, and we're only looking at flatbed right here. This shows us how many outbound loads there are. What is the volume like in a state? This shows us how many trucks are going to that state to drop off loads. So we need an area where there are more loads than there are trucks coming to drop off. In the Plain States, for the first time that I have seen, Oklahoma is actually decent or more decent than it was over the past few weeks. There are more loads than trucks. In the Midwestern states, it's just Illinois. In the southern states, we have Alabama, Arkansas, Georgia, Louisiana, Mississippi, South Carolina, and Virginia. In the western states, California, Idaho, Oregon, Washington, and in the Northeast, Delaware, Maryland, and Maine. Now, something I do want to mention, it's important, this doesn't tell us anything about lanes, right? As I always say in these videos, The western states, a state like California or Oregon, where there are constantly more loads than there are trucks, it's a good place to be, but the best rates will be going back to the West Coast, not to a place like Texas or whatnot. So something to keep in mind is that this does not tell us about lanes. Finally, we have this map for visual learners. Basically, it shows us flatbed supply and demand. The darker an area, the more loads there are, less trucks. That means that there is undercapacity, more negotiating power. The lighter an area, it's the opposite. There are not enough loads and too many trucks going in. So what I can see from last week is that the West Coast is dying compared to last week. The South is still staying strong, it looks like, as well as Indiana and Illinois, maybe Ohio a little bit. They're interesting, but for the most part, it looks like the South is still the best place to be. So that's it for our market update this week. On one hand, it seems like we're heading in a better direction than in previous weeks. On the other hand, I'm not sure whether it will stick. Now, as many of you already know, I'm usually a positive and hopeful person for the most part, but something that I have learned over the past few months is that not only are we in a very less than ideal market at the moment, to say the least, we're also in a very unstable market. And instability causes me not to trust it. So I'm going to approach any good news with caution. So yeah, cautiously optimistic is where I would like to stay at the moment. But I have to tell you, it was much easier for me mentally when I didn't know anything about the market. It really is true when they say that the more you know, the more you suffer. Honestly, sometimes being oblivious it can get you into trouble, but at least you'll have that peace of mind. Anyway, guys, for now, I think we should celebrate the upward movement in the market, hope that it continues moving upward, but still be prepared just in case. Hope for the best, be prepared for the worst. That is a good position to be in. And of course, remember, those that survive this crazy market situation are going to come out stronger in the end. Anyway, guys, thank you so much for watching, and I'll see you in the next video.